Hello, Nick Hubble. How are you doing, mate?
Yeah, it's good to see you again, Woody.
I know feels like it's been a long time, actually. It's been a good few weeks, maybe even a couple of months since we last had a chat. But everything okay with you, mate?
Yeah, it's going well.
Yeah, that's good. I wanted to get you on camera to have a good chat, actually, because there's a lot of talk in our editorial team at the moment about how markets look pretty stretched at the minute, and we're coming out with a pretty decent new report from Vern Gowdy next week. As you know, he's always been a pretty bearish, but it's a pretty preeminent report, and you've just come out with, well, it's not been published yet, but you've got a special report in the works for Strategic Intelligence Australia readers. So I thought we could just talk about some of the ideas ahead of next week and get your thoughts on it. Now, you start with a kind of description about how your daughter has just gone into childcare, and that every time she comes home, she gets a big fever. And it was kind of a nice little personal story about how, the worst thing to do is to try and bring down the temperature. And that's a good analogy for the way central banks are going to deal with a certain crisis coming up. Do you want to just explain that a little bit? So you probably explain it in less cryptic terms than me, but.
Yeah, let's hope so. So, like you say, it's an analogy that everyone can understand. Why you don't throw a 1-year-old into an ice bath when they've got a fever. It's a very bad idea, and there's lots of science behind that, which I don't understand. Something to do with fevers actually help to deal with whatever is causing the fever. And for many decades and centuries, even medical professionals would make the mistake of dealing with symptoms instead of dealing with the underlying cause. And so, with that analogy and that background, my argument is that the same thing is about to happen to the financial system and to the economy, that central bankers are about to do the equivalent of throwing a toddler with a fever into an ice bath in order to try and get the temperature back down to the level where they want it. And in doing so, they'll trigger, obviously, a much worse crisis than the actual fever and what's causing the underlying fever.
Yeah, now, so let's relate that to real world events. So we're talking specifically the relationship between the rising inflation and the burdening energy crisis. What mistakes are central banks making in those two things?
Yeah, so I'm worried they're going to make a mistake. They haven't made it yet. And I think the context is the all important thing here. So for about a year now, I've been warning about inflation continuing to rise and it rising in the first place. And over the last few weeks, because of this energy crisis, because of the spiking energy cost, I've become worried that actually it's not inflation that investors should be worrying about in the short term. I believe there might yet be one more deflationary crash triggered by higher interest rates. So if you look back through history, we've had, since about the 80s, this cycle of falling interest rates. But during that cycle, there's been little blips of increasing interest rates. And each time interest rates increase, there's some sort of crisis, and then they fall to an even lower level. And then after the crisis is past, they increase again, and then there's another crisis, and then they fall to an even lower level. We've had that sequence over and over again, especially in the US is where it's most obvious because that's the global reserve currency. And what I'm arguing really is that is going to repeat at least one more time. We're not going to get this outbreak of inflation that I've been warning about yet. We might be in for one more sequence of tighter monetary policy leading to another crash.
Right. So why is it that people might be mistaking the energy crisis for an inflation crisis? Why do you think that's the case?
Yeah. So the energy crisis is what has made me concerned. And what people need to understand here is that even though the definition of inflation is supposedly rising prices, there is actually many different reasons for prices broadly to rise. And only one of those reasons is the sort of inflation that tighter monetary policy should be used to deal with. If, for example, the prices of all of our goods are rising because of an energy crisis, just hypothetically speaking, of course, then tightening monetary policy is a very, very bad idea. It's like throwing a toddler with a fever into an ice bath. It's the worst possible thing you can do. The reason that we've got a big burst of inflation coming over and above the usual type of inflation that I've been warning about for a year now is because of energy prices rising, because of this energy crisis. And my worry is that central bankers who have been going on about inflation just being a temporary, short-term, transitory phenomenon for a long time, will mistake this sudden burst of rising prices because of the energy crisis as an outbreak of the normal sort of inflation that they are supposed to deal with. Now, if they do make that mistake and they say, oh no, prices are rising, we've got to tighten interest rates, tighten monetary policy by raising interest rates, and they do that while the economy is in a crisis because of the energy crisis, then there will be another debt crash, just like 2008 or the savings and loan crisis, or all of those crises we've had since the 80s. It's going to be the same playbook once again. And I think it could be dramatically worse because they'll be tightening monetary policy during an energy crisis, not just during a bit of inflation that tends to happen and has happened frequently over the last 20 or 30 years.
Mm. So that's what you describe as pretty much the biggest mistake that central bankers are likely to make of all time.
Yeah, so it could be the greatest policy mistake of all time because it's their job to deal with inflation, but inflation and rising prices are not always the same thing. And if prices are rising because of an energy crisis, then the worst thing you can do is tighten monetary policy because it's going to trigger a debt crisis to go with the energy crisis. I think this is an inherent flaw of central banking to conflate inflation, meaning the devaluation of money, with rising prices. Now, the rising prices are the symptom. They're like the fever. They're not the underlying cause. So it's really important to distinguish between why are prices rising. Is it because the money is being devalued, or is it because of supply and demand issues? Now, there's a really important saying, I think it comes from Chicago commodity traders. The idea is that the cure for higher prices is higher prices. The idea being that by having a price spike like we are in energy markets right now, you reduce demand and incentivize more supply. So that's the free market solving the problem. It's the price mechanism telling people there's not enough gas. Everyone who can avoid using gas should use less, and everyone who can produce more gas should produce more. So that is, like the fever. It's the fever trying to solve the underlying problem. Now, if you mistake that for the sort of inflation that is the devaluation of money, and you raise interest rates, think about what happens to consumers and to gas producers when they have tighter monetary policy coming. They pull back on their production even more, and they have debt crises and companies go bust. It's the worst possible thing to do, and it prevents the natural cure from playing out in financial markets by allowing those higher prices to make incentives work in favor of the system and to solve the problem over time in the best and most efficient way possible.
Why? It makes perfect sense. Why is there such resistance to the free market in these things?
Well, the central banks are price fixing cartels. That's the basic purpose. So if you think about it, we don't fix the price of anything else in our economy, but we fix the price of interest rates, which is the price of money. And thereby, because money is half of every transaction, there's this price fixing cartel that's got its fingers in all of the economy's pies. That's the basic function of central bankers. So if you've got a price fixing cartel at the very center of the economy, it's no surprise that they're resistant to the free market system. But perhaps more importantly, whenever you have a crisis, you can't blame the free market when you've got a price fixing cartel fixing interest rates, which is half of every transaction price of money. It's absurd.
It's huge collective thinking, but you just don't know. You don't know where an individual demand makes up an overall economy, right? This is my very basic understanding of it. So if you've got someone coming over the top trying to decide where supply should be and where it just doesn't work. It happens from the ground up, doesn't it? Not from the top down.
Yeah, well, it should. And that's the only way to make things efficient. So central planning doesn't work. But for some reason, we got rid of all of these price controls all through Western economies, and socialism and collectivism and all that was a bad idea, and we know that. But for some reason, we kept central banks, which are the biggest price fixers and central planners that you could possibly have. And yet people still think this is somehow part of the free market system, which is a bit bizarre. But as far as I'm concerned, they are the ones causing this boom and bust cycle by having interest rates too high or too low, encouraging these debt booms. And especially investors right now, they've seen and realized this because the central bank's policy is determining all of the financial market outcomes, and investors are paying more attention to central bank policy than anything else right now. And I think that highlights just how uncapitalist or unfree market the system is, and it explains how these huge imbalances grow over time. And it explains why a policy failure like the one that I'm worried about is so important. It just dominates everything else.
Mm. Just before we get to that, can I just ask you just something else that just occurred to me out of my own interest? Has the central bank ever done anything that you think in its history that's actually had a positive effect? I'll give you one example. So in the early 80s, when Paul Volcker took over he was the chairman, right, during Reagan's time, it was a hugely unpopular move. I mean, there was effigies burned of him when he kept interest rates really high, but that ended up being a positive thing, didn't it? That allowed for the recovery for the boom in the 1980s, did it not?
Yeah, so he cleaned up the mess that central banks before him.
Yeah,
but you've got to understand that you can't just compare a central bank's actions to, well, what are you going to compare it to? Under a free market system without a central bank, you wouldn't have had the boom. You wouldn't have needed that absurd bust. You wouldn't, who are you going to burn effigies off? It's only the person who's causing the problems. So I think what you've got to understand is that central banking is inherently bad.
Yeah.
And central banks inherently shouldn't exist. And that we've got the consequences playing out all day long of the fact that they do exist. And the key part of what you just said is that it took a pretty horrific economic crunch in order to bring inflation back under control. It took extremely tight monetary policy.
Huge unemployment as well.
Huge unemployment.
Yeah.
I think it was the biggest in the UK. Was the most mortgage defaults, or the biggest defaults on small business loans ever, unsurpassed, even adjusted for not adjusted for the population changes and all that sort of thing. But what you've got to hear right now, and this is the most interesting part of what's in the special report, as I see it, is the fact that central bankers are starting to sound like Paul Volcker. They are saying we might have to increase interest rates, even though this is going to damage the economy. The Bank of England governor said that. I think it's the central bank governor of, it was Hungary or the Czech Republic or one of those Eastern European nations, where they did a surprise interest rate increase. And both of those central bank governors or presidents, or whatever they are, they made it very clear they were doing this despite the fact that it would harm the economy. And in the case of the Bank of England governor, he made it clear that this was despite the fact that the economy might not be able to bear it. There was a great article about a speech that he gave in which he said, everything's gone wrong. The only thing missing is a plague of locusts. It referred to that in the biblical line. So central bankers are realizing that they've engineered this big inflationary boom that they thought was transitory, but isn't. They've realized that they might have to raise interest rates in order to bring it back under control. They know that's going to be terrible for the financial markets. But here's the key bit. The interesting thing about the energy crisis, which is the particular issue that's tipped the central bankers over the edge to start worrying about inflation and being willing to raise interest rates despite the damage it will do. The thing that's tipped them over that edge is the energy crisis, right? Now, the energy crisis is not true inflation, first of all. And more importantly, the energy crisis is transitory, right? So that problem would solve itself over time without tightening monetary policy. Energy prices will come down over time without tightening monetary policy. And yet that is the issue that they've chosen to focus on as engineering the inflation that might make them tighten interest rates. So it's unbelievably ironic. You couldn't make it up. And it's the perfect illustration of why, when you have a central power in charge of something like interest rates, and it leads to these bizarre situations where at some point they're going to make a mistake. And when they do, you get these financial crises.
Just before I ask you how an energy crisis turns into a debt crisis, can I just say, so a lot of your work is focused over in Europe and in the UK, and I know you write to the Australian audience as well. But when you say the cure for higher prices is higher prices, but the trouble is there's a political thing in the energy over there. So even if they wanted to, it's not politically convenient to let oil and gas explorers, for example, explore for more gas, because that's not on the political agenda, is it?
Yeah.
So can that even happen?
Changing.
Yeah.
Even politicians are not immune from market forces in the end. So they're looking at approving Nord Stream 2, the gas pipeline, to try and get more gas. And there's all of these changes and shifts happening to solve the problem of higher prices. There's licensing problems in the UK, which are going to get resolved. They allowed Eastern or European truck drivers into the UK to try and help with the petrol shortage. So all of these initiatives started to have to happen. They had to liberalize all sorts of things. The best example is probably the fact that there's all of these energy companies in the UK that supply energy to retailers. And there's also a price cap on retail energy prices in the UK. And so, of course, when energy prices spiked on the wholesale market, a load of energy companies went bust because they couldn't increase the price to pass on the increasing cost. It was not legal. But of course, that's still solving the problem because the energy companies go bust and then a new supplier comes in at a much higher price. And all of these people who were getting away with paying artificially low energy prices are now forced to pay the higher price. So the market is resolving it. Unfortunately, because of government regulation of the price, the resolution involves a whole bunch of energy companies going bust. But nevertheless, the cure for higher prices are higher prices. The capitalist system is, despite the price controls on retail energy, is making its presence felt. And the government, all price controls fail. All government price controls fail. It's just a question of how. So in the end, the free market, breaks through. So I think even the political reasons for not having huge amounts of gas in Europe are changing. They all went back to coal. All of these nations in Europe who were phasing out coal, they've gone back to coal. In China, the Chinese started accepting Australian coal because of the higher energy prices. So the higher prices, the cure for higher prices is higher prices. Idea is still working quite well. It's just that the political resistance tried to prevent it, but in the end, they always fail, and it just wreaks havoc in the meantime.
Yeah, right. So how does an energy crisis turn into a debt crisis then?
Yeah, so it's this mechanism of tightening monetary policy at the worst possible time, mistaking rising prices because of an energy crisis for rising prices because of inflation, and not being able to tell the difference between the two, and not understanding that the energy crisis is, however long it lasts, a transitory phenomenon because higher prices cure the problem. And therefore, tightening monetary policy when the economy is dealing with an energy crisis is, kicking a man when he's down or throwing a toddler who's got already sick with a fever into an ice bath. It's the worst possible thing you could do. And it repeats this cycle that we've had since the 80s of every time interest rates go up, it's only a matter of time before there's some sort of crash somewhere. I think trying to identify specifically what sort of debt crisis is triggered is sort of like trying to pick which snowflake causes the avalanche. It's missing the point.
Yeah.
So, there's Evergrande and the Chinese property sectors is all over the news, or who knows what the debt crisis could be. Usually it's something unexpected by its very nature, which is part of the point. But this cycle of every time monetary policy tightens, eventually it ends in some sort of crisis, and then you get an even looser cycle of monetary policy, which of course inflates the next bubble. The idea that will repeat is the key. The question that investors face, as I see it, is how many more times will we have a debt crisis as a result of tightening monetary policy, followed by an even looser monetary policy cycle? How many more times does that repeat before you get the end game, which has historically always been inflation, as central bankers basically are forced to monetize everything to print enough money to cover up all debt crises? Until about 3 or 4 weeks ago, I thought we might have passed already that final cycle. Now I'm really worried the energy crisis is going to lead to one more sequence.
Yeah, right. So when are you expecting this to happen, or is that another pie in the sky question? You don't really know when, you just know it's going to at some point.
Yeah, so I definitely don't know. It might have already begun. We might already.
That's not why I got you on, Nick.
Yeah. Well, the timing is effectively impossible to get right because, like I said, it's the snowflake that causes the avalanche. The people who are looking up at the snowflakes, they're going to see thousands of them. But the people who are looking at the snowpack and saying this is going to go wrong at some point, I've got the real point. It's also possible that we won't get another such crisis and that we will get this inflationary boom instead, that central bankers will chicken out and won't raise interest rates, despite the fact that inflation is soaring. That was my prediction a few months ago. And it's possible that they'll come to their senses and say, this is an energy crisis. But to me, the risk has shifted dramatically from inflation being in our future to one more debt crisis before we get that inflation. And so I think investors need to be very careful right now about rebalancing, away from just assuming that inflation is going to hit and continue to hit, and towards this idea of one last great monetary policy mistake happening. I wish I knew when, but we don't even know for sure that it will happen. The fact that the Evergrande China stories, the fact that there's this energy crisis in Europe, the fact that the Bank of England governors talking about tightening monetary policy, the fact that Eastern European and a few other countries have tightened monetary policy suggests that we are going to get tighter monetary policy to some extent. That's already happening. So now it's that quote about when the tide goes out, you find out who's been swimming naked. Well, the tide started to go out, right? And I don't know who it is. I'm not sure I want to know who it is either, but there's a good chance that someone out there somewhere, it might be Evergrande, is swimming naked.
Yeah. And finally, what's your stance on what people should actually be doing about it? I mean, I know you are the investment director of Jim Rickards' Strategic Intelligence here, and you've got a high propensity towards gold and gold-related assets. Is that still the case? And is there any other plays that you can hint of that you or Jim are looking at in the future?
Yeah, I think the key theme right now would be keeping your powder dry for a little bit longer. Staying in as much as I hate saying this, staying in government bonds, staying in cash, getting ready to buy things on the dip of that final crash, including gold stocks and gold. It's important to remember that gold goes down at the initial part of a crisis. It's only at the worst moment of a crisis, or close to the worst moment, that gold turns back up and then goes on to a subsequent bull market after a crisis, not during. So gold is not a crisis hedge. It's an artificially induced monetary policy recovery hedge, which is a bit strange, but I've explained that elsewhere. So I think waiting for things to crash is the right thing to do with half of your portfolio, and the other half should be getting ready for things like inflation, which I still think will come eventually. Whether or not we have one more crisis is what we're really talking about first. And I think most of what individuals should be doing shouldn't be focused on trying to time these markets, at least too much. Like I said, I don't know if we'll have this one more crisis, even if the risk of it has dramatically increased. So longer term inflation hedges are a good idea. And I think we're seeing that play out with booming property prices all around the world. That's the biggest example, because during inflationary periods, properties are a great investment because of the high leverage behind it. So your debt gets inflated away. Yeah. I think that's why property prices are booming globally. The other option, I think, is commodities. One of the odd things about the next decade or so is that I would expect commodities to outperform, just because we're at the bottom of a cycle in commodities relative to financial assets. And yet everything I'm describing about is not some sort of big economic commodity-driven boom like we had in the mid-2000s for Australia. And the only way I can reconcile those two facts is with stagflation. So commodity prices will go up and commodity prices will boom, but it won't be part of a broad-based economic boom like we had during China's boom before the financial crisis. So I think commodities as an inflation hedge, and because they're undervalued, are a good place to be. Commodity stocks or commodities in various other ways. My worry right now is that we've seen a very strange phenomenon, which I can't explain, which is commodities both boom and then bust incredibly quickly. And we've seen that with lumber, iron ore, and a couple of other commodities. And the commodity, let's call it the Twitterati who focus on commodities, are always focusing on the one that booms, and then they sort of go quiet during the bust. And I think you've got to be aware of the fact that both are happening each time. I don't know what that means. I don't know what's going on and whether that is going to happen with the energy crisis as well. Whether this huge spike in energy prices, and in terms of gas, it's absolutely mind-boggling how much the gas prices increased. Whether that's going to be followed by a bust, just like so many other commodities. Uranium's another example, where we had a spectacular boom and then a bust. And whether that's financial speculation or some sort of short position issue or issues with logistics and supply chain disruption, I don't know what's causing that. But people who are heavily into commodities because of the inflation story need to be aware of the fact that all the booms we've seen in commodities, not all of them, but a good chunk of the booms we've seen in commodities over the last few months have been followed by busts. And so I think people need to be very careful about not getting drawn in to what seems to be going parabolic unless you do it very early on.
Yeah, right. Oh, that's great, Nick. That's fascinating. Thanks for your time. We'll leave it there for today. I guess the only thing I'll say to that is what you said at the end. It's like you're not sure what's happening or why these boom and bust cycles are happening, but that's the whole point of our business, really, is that we think about these things, and it's what we do on a weekly basis. And over the coming weeks, I'm sure you'll have some answers for everyone, followed by a ton more questions, I'd imagine, as things go.
The questions are always more interesting than the answers.
Yeah, they are. Yeah. Well, cheers, Nick. Look forward to that report coming out next week. It's actually called, you've actually titled it, Is the energy crisis just the beginning? So if you're a strategic intelligence reader, you'll get that next week. And I'm sure I'll summarize it for everyone else in the weeks to come. Thank you very much, mate.
Pleasure.